For more than 2 years, investors have been waiting for exits in private markets to make a comeback, and it seems like the wait is finally over. The signs are looking good. In the US, exit values jumped by 51% in the first 9 months of last year, compared to the same period in 2023. So what's driving this momentum, and why do we think it's set to grow in the years ahead? Firstly, central banks globally have started cutting interest rates, which is bringing down financing costs. It's also making it easier for buyers and sellers to agree on a price, which typically leads to greater deal flow. Secondly, private equity-backed IPOs are gaining traction. We saw a significant rise in activity in the US last year, and if stock markets stay robust, we do think the IPO trend is likely to continue, which is another good news for liquidity in private markets. And then there's also the fact that private equity is sitting on a mountain of dry powder, while the backlog of unsold assets is growing. And as interest rates continue to adjust, we do expect these assets to start hitting the market in larger numbers. And finally, secondaries. As many of you know, a very big topic for us here at Moonfare, and secondaries are playing a much bigger role today compared to just a few years ago. Fund managers have been increasingly using them to provide liquidity to investors, and we believe secondaries will remain a key exit channel even as more traditional routes reopen. Of course, we also need to flag the usual disclaimer language around uncertainty and risk. Markets are still volatile, and geopolitical risks are keeping some investors cautious. But there's a growing sense of optimism from our partners that the industry is finally in full recovery mode. What else has 2025 in store for private markets? To find out, check out Moonfare's annual outlook by clicking the link in the caption.